Hey guys, it's Julie here with TipRanks, and today we're taking a look at 3 top analyst tech stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 stocks in the technology sector that come in with a strong buy consensus, but also have recent ratings from some top ranked analysts. So we'll take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We found today's companies using the top analyst stock page on TipRanks. Found right at the top of the Ideas menu, this top analyst stock page will show us companies that have gotten attention from some 5-star analysts recently. We're looking for a strong buy rating and narrowed it down to the Technology Center, which gave us 6 stocks down below. Just before we get into these stocks today, this is your reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now we're going to kick things off with Silicon Motion. They trade under the ticker SIMO and are currently priced at $79.48 per share. In the past year, they have climbed nearly 28%, and in the last 3 months are up slightly, about 0.5%. Silicon Motion is a leader in developing NAND flash controllers for solid-state storage devices. They develop, manufacture, and supply semiconductors for the electronics market. You can find their products across a variety of applications, such as automotive systems, smartphones, and PCs. Since 2014, they have shipped over 731 million SSD controllers, and they are the largest SSD controller supplier since 2021. On May 2nd, the tech company shared their first quarter earnings report, where they saw both an earnings and revenue beat. They reported Q1 earnings per share of 64 cents, coming in 8 cents ahead of analysts' expectations. Revenue came in at $189.31 million, beating by nearly $9 million. And while revenue did decrease 6% quarter over quarter, it did increase 53% year over year. The company also increased their future outlook. They're now anticipating revenue of $800 to $830 million, which would represent 25 to 30% year over year growth. Their president and CEO noted that their highly differentiated controller solutions enable PC and smartphone OEMs to utilize high-performance, higher density, and lower-cost SSD to enable cutting-edge applications such as AI at the edge. Recently, reiterating a buy rating on the Silicon Motion stock was 5-star analyst Craig Ellis from B. Riley Financial. The analyst noted that the company lifted revenue and gross margin solidly above the prior midpoints, and the firm is encouraged by strong-looking execution inside the industry's nascent PC and smartphone recovery. They believe the preliminary Q2 report as supporting a bullish thesis on the shares. With 9 current analyst ratings, the stock does come in as a unanimous strong buy. And the average price target of $94.38 would imply an upside potential of 18.5% from current prices. Looking at our ratings down below, we can see 5-star analyst Craig Ellis here. His price target would imply an upside of over 40%. That is our high-end price target, and the low end does come from Wedbush here with an upside of about 7%. For our second top analyst stock, we're looking at Instructure Holdings. They trade under the ticker INST, currently priced at about $24 per share. Overall, in the past year, they are down 7.8%, but you can see in recent months here, they've been climbing back upwards, gaining 17.5% in the last 3 months. Instructure Holdings is an educational technology company dedicated to helping everyone learn together. Founded in 2008, Instructure developed Canvas, which is a cloud-based LMS that offers assessments, video learnings, gradebooks, and more. Teachers use Canvas to create and manage coursework, while students can access it for their homework, grades, and lectures. Canvas is the #1 teaching and learning software and was the foundation of the Instructure platform. They've also created an assessment management system called Mastery Connect and a tool called Impact, which helps school districts deepen EdTech adoption by helping admin get specific about how tech is being used. Instructure shared their Q1 earnings report on May 8th. Once again, we have another earnings and revenue beat, and the company also touched on a recent acquisition. For their first quarter, they reported earnings per share of 22 cents, beating estimates by 8 cents and growing over 15% year over year. Revenue came in at $155.5 million, which was also ahead of expectations and grew over 20% year over year. They completed their acquisition of Parchment, which is the world's largest academic credential management platform, and this will help them expand their networks and customer base, unlocking exciting new growth opportunities. Management said that their first quarter results exceeded all guided metrics and demonstrated the durability, operational scale, and breadth of the Instructure platform. Following that Q1 earnings report, five-star analyst Joseph Fruwink from Robert W. Baird reiterated their buy rating on the Instructure stock. He noted the company's robust set of financial indicators and market performance. Instructure has demonstrated significant efficiency, leading to an EBITDA margin increase from 38 to 42%, which exceeded the estimates. This growth in revenue and margins, combined with an upbeat forecast for 2024, signals a strong financial position and potential for increased profitability, contributing to his outperform rating. The Instructure stock currently has 7 analyst ratings, and once again, we have a unanimous strong buy. The average price target comes in at $29.50, implying an upside potential of about 22.5% from current prices. Looking at our list down below, fairly close range of price targets. Our low end is a couple price targets with an upside of 16%, several in the mid-20s, and our high-end price target comes from Needham with an upside of over 32%. If you've made it to our third stock today, this is your reminder to make sure you've hit that thumbs up button. Last but not least, we're taking a look at JFrog. They trade under the ticker FROG, or FROG, currently priced at $35.59. In the past year, the stock has climbed 30% overall, but has cooled off in the last 3 months, dropping 13%. JFrog provides an end-to-end hybrid universal DevOps platform, working to achieve continuous software release management, or CSRM. The CSRM platform enables organizations to continuously deliver software updates across any system. With their liquid software, they aim to create a world of delivering software from developer to device without friction. Their platform is available on-premise, open source, or in any cloud. The company boasts that 83% of Fortune 100 companies, plus millions of developers globally, trust their company as their end-to-end software supply chain partner. The JFrog stock did slump after their Q1 earnings report back on May 9th, despite solid results. Both earnings and revenue beat expectations, but it seemed investors were left with wanting more. For their Q1, they reported earnings per share of 16 cents, coming in 2 cents ahead of expectations and jumping 10 cents from the year prior, while revenue came in at $100.3 million, which grew 26% year over year. They also saw their cloud revenues grow 47% in the first quarter, and customers with annual recurring revenue greater than $1 million reached 40, which was up 90%. Management said that Q1 was another quarter of strong execution as they exceeded the high end of their guidance measures. Five-star analyst Koji Ikeda from Bank of America Securities reiterated their buy rating on the JFrog stock. And they referenced the company's acquisition of Quack AI, saying that the move will better entrench JFrog into enterprise DevSecOps workflows and bolster the company's ability to meet its ambitious 2027 financial targets, including a compound annual revenue growth rate of 22 to 24% from 2024 to 2027. Unlike the others, JFrog does not have unanimous buy ratings, but with 15 current analyst ratings, it does come in as a strong buy with 13 buys and 2 holds. And analysts' average price target comes in at $46.38, implying an upside potential of over 30% from current prices. Looking at some of those recent ratings down below, we do have our 5-star analyst here from Bank of America with our high-end price target of $54 for an upside potential of nearly 52%. And on the low end, we do have a hold rating from Scotiabank with an upside of 12%. So that is a quick look at 3 top analyst tech stocks. Let me know your thoughts on these companies in the comments down below. I always love hearing from you guys, and head over to the TipRanks website to try out the top analyst stock page for yourself. If you made it to the end of today's video, don't forget to hit that thumbs up button and make sure you subscribe to the channel as well. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you're doing your own research and due diligence. Thanks so much for watching. Have a great day, and I'll see you back here next time.